Well, good morning. I'm Jaginder Rana. And the topic of the day is general insurance penetration rising in India. General insurance penetration rising in India. The insurance penetration in India has made significant strides in recent years. But there is still much to be done. The regulator has already introduced pivotal changes, starting with giving insurers the freedom to design bespoke products. Earlier, the same products were offered in both urban and rural markets, limiting relevance and accessibility. Now, insurers have the flexibility to create customized solutions tailored to specific demographics and regions. So, the distribution framework has also evolved. Many companies now leverage advanced digital tools, and the regulator's Insurance for All by 2047 vision has allocated states to specific insurance companies. Additionally, initiatives like the Bima Trinity, that is Bima Sugam, Bima Vahak, and Bima Lokpal, are set to revolutionize the landscape. So, for example, Bima Vahak empowers women to sell smart tickets, relevant and comprehensive insurance products using digital tools, bringing service directly to customers. This localized technology-driven model ensures better outreach and faster transactions. There is already a progress. Insurance companies are investing in new offices, recruiting Bima Bags, and developing region-specific strategies. These efforts are expected to show significant results in the near future, transforming the penetration landscape. So, while significant progress has been made, it is important to re-examine how we measure insurance penetration. Traditionally, penetration is assessed as premium as a percentage of GDP, that is gross domestic product. However, this metric doesn't capture the full picture. From financial year 2014 to financial year 2023, India's population grew by around 10%, but the number of new insurance policies tripled in the same period. Despite this, the average premium size grew by only 1.3% annually. So, this suggests that while more people are being covered, the total value of coverage, the quantum of cover, may have increased significantly. Take motor and crop insurance as example. Motor insurance rates have remained stagnant, while crop insurance rates have dropped in recent years. So, while the premium to GDP metric suggests low penetration, the actual coverage and reach may have expanded substantially. This is similar to how telecom penetration is assessed. Indian tariffs are among the lowest globally, but telecom uses and penetrations are robust, indicating that revenue is not the best indicator of market reach. So, similarly, in insurance, we should focus more on coverage metrics rather than just premiums. The insurance industry is on a transformative journey with the aim of covering the entire Indian population by 2047. So, this requires significant innovation, particularly in digital distribution. By 2047, decision makers at home will predominantly be individuals born in the digital era. This highlights the need for the insurance sector to integrate technology not just for efficiency but as a core strategy. So while banking and telecom have taken the lead, the insurance industry is catching up with many companies already leveraging digital frameworks. In addition to ongoing initiatives like state level insurance plans and streamlined product approvals, so the focus should shift to sharper tech enabled strategies to engage millennials and Gen Z. So these emerging audiences demand convenience, transparency, and relevance, which can be addressed through digital first approaches. Overall, while foundational steps like regulatory reforms and distribution enhancements have set the stage, the next leap requires embracing digital transformation to reach new audiences effectively. So over the last decade, the industry has grown at a CAGR compound annual growth rate of around 12.5%. From the current premium of rupees 2.9 trillion, reaching rupees 11 trillion would require doubling twice. So at a 14 to 15% CAGR, this could happen within a decade. However, within initiatives like the Bima Trinity and state level allocation plans, the timeline can be accelerated. For example, the state level allocation has prompted companies to expand into underserved regions like Sikkim. So, with sustained innovation and adoption, we could potentially achieve this target in about 7 years, provided annual growth hits 20% of CAGR at some point. So while growth may not be linear, the ecosystem's digital transformation could trigger an exponential leap in the coming years. The Bima Trinity, particularly Bima Sugam, should reduce distribution costs. However, cost reduction was not its primary objectives. The platform aims to make insurance more accessible, transparent, and user friendly. Think of it as the Amazon of insurance, bringing buyers, sellers, service providers, and distributors onto one platform. So, this unprecedented level of transparency will drive efficiency. Customers will clearly understand costs, and distributors will benefit from economies of scales. So while distribution cost reduction will likely occur as a byproduct, the primary goal remains improving accessibility and transparency. So one key strategy is bringing transparency to the process. Another important aspect is improving the efficiency of distribution. When distribution becomes more efficient, it leads to cost savings, which in turn enhances the economic viability of both the insurance companies and the entire ecosystem. So these savings can then be passed on to consumers, making the product more affordable. As we open up distribution channels and use more efficient methods to reach consumers, we can expect this shift globally. For markets where insurance penetration is already decent, the focus should be on optimizing product offerings. The health insurance sector, as well as other product lines, is still evolving. There is room for distribution growth, and efficiency is catching up. As this happens, insurers will be able to create more affordable products. So, from our experience as a relatively new player in retail health insurance, we have seen that distributing products directly to consumers helps improve efficiency, which allows us to offer simpler, more affordable products. Customization is another key focus, creating products that are tailored to specific needs rather than adopting a one-size-fits-all approach. So leaders in the industry are already moving in this direction, creating data-driven, customizable products that further improve affordability. On the regulatory side, it is important to create products that are not only convenient for consumers at the time of purchase, but also when it comes to claims. Sharp underwriting practices help reduce fraud and prevent leakages, which contributes to overall saving and ensures that the benefits are passed on to genuine policyholders. Efficiency across all these areas is crucial for improving affordability. So there is a lot of discussion around goods and services tax rates, particularly whether a reduction in GST will make health insurance more affordable. If we are talking about health insurance, a reduction in GST would make policies more attractive as they would appear more affordable. However, this is just one element of the bigger picture. To address the broader issue of affordability, there are several factors at play. First, the majority of people in India don't have individual health insurance. So the question is, at what age do customers typically buy insurance? Our population is aging and the likelihood of illness increasing with age. As we have more young people entering the insurance market, the premiums will naturally come down. So despite the increase in medical inflation, insurance companies must price their products appropriately to ensure customers level secure. The lowering GST would make health insurance appear more affordable. But it's a long-term process. Awareness campaigns and simplifying insurance products are also important steps to ensure that more people opt for coverage. For senior citizens, there have already been some amendments in tax policy which will certainly make health insurance more affordable for them. I think accessibility has been addressed with a range of initiatives, including regulatory changes. However, when we discuss affordability, we should consider how India compares to the rest of the world. Health insurance premiums in India are among the cheapest globally. The perception of that premiums are unaffordable often doesn't reflect the reality of the market. There are several ways to make health insurance more affordable. One major factor is the GST. Currently, GST collection from health insurance policies is used by the government to fund state level insurance plans. But the question we need to address is whether it would be more effective to remove GST and enhance private sector penetration, which would likely lead to better affordability. So ultimately, removing GST could be a more effective way to increase insurance penetration than relying on state-provided insurance. A reduction in GST, which is currently 18%, would have a significant impact on affordability. So this benefit would certainly be passed on to the customer. The first impression for the consumer is influenced by the cost. So for insurance, if an insurance premium is rupees 25,000 and the GST is reduced, say from 18% to 12% or 5%. So the lending cost for the consumer drops to rupees 23,000 or less. This reduction makes the premium appear more affordable as the immediate price for difference of a couple of 1,000 rupees can significantly impact the consumer's perception. This affordability factor plays a key role in influencing purchasing decisions. Additionally, there is an ongoing discussion around value services with insurance companies actively making representations on this front to further enhance the overall appeal of insurance products. So the insurance penetration in India has made significant strides in recent years. But there is still much to be done. The regulator has already introduced pivotal changes, starting with giving insurers the freedom to design bespoke products, and the distribution framework has also evolved. Many companies now leverage advanced digital tools, and the regulator's Insurance for All by 2047 vision has allocated states to specific insurance companies. Additionally, initiatives like the Bima Trinity are set to revolutionize the landscape. So the progress is there. Insurance companies are investing in new offices, recruiting Bima Box and developing region-specific strategies. Thank you very much.